So Rob, I was thinking of starting my own small business, and I understand that I need to record transactions, but I'm not too sure where I record them and if I record them as an asset, an expense, a liability, or owner's equity or income. So I was wondering if you could help me
Yeah,
with that.
no worries. So when you're starting your own small business, or any business for that matter, using accounting is essential in being able to identify, record, and then communicate this information with decision makers. In the case of a small business, that would usually be the owner. By using double entry accounting, you can monitor accounts and see the effect of transactions on accounts, enabling the business to operate at maximum efficiency and record information correctly.
An asset is defined as a resource controlled by the entity as a result of past transaction or past events and from which future economic benefits are expected to flow to the entity. An example of an asset is a delivery van. We know this because a delivery van represents a future economic benefit as it helps generate profit, results from a past transaction when the van was purchased and controlled by the entity, which means the business decides how we use it.
Yep, so a liability is defined as a present obligation of the entity arising from past events. The settlement of a liability is expected to result in an outflow from the entity of resources embodying economic benefits. An example of a liability is a bank loan. We know that a bank loan is a liability because a bank loan represents a present obligation as it has to eventually be paid. It results from a past transaction when the bank loan application was approved, and the settlement of the bank loan is expected to result in an outflow of resources in the form of cash.
Right. Owner's equity is defined as a residual interest in the assets of the business after the deduction of its liabilities. Rather than there being specific characteristics of owner's equity, it is simply a formula: assets minus liabilities. The two most common owner's equities items are capital contributions made by the owner and drawings.
Okay, so income is defined as increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity, other than those relating to the contributions made by the equity participants. An example of income is sales. We know sales is income because it does increase economic benefits during the reporting period, either through when a sale is made, raising cash, or through raising a debt when a credit sale is made. Sales are a result from a past transaction when the sale was made and results in an increase in equity due to the fact that the owner is entitled to the business's profits.
Right. Expenses are defined as decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrence of liabilities that result in decreases in equity other than those relating to the distributions of equity participants. An example of an expense is wages. We know wages is an expense because it decreases the economic benefits during the reporting period, which results in a decrease in equity due to the fact that the owner is obliged to use business funds to pay for the staff.
In conclusion, by following the definitions and key characteristics of each element of accounting, a business can correctly record transactions as they occur, which helps to facilitate effective decision making and maximise profit.
Thanks.